Okay, so obviously with gold trading at highs not seen since 2011, we're getting a lot of inquiries as to how people should be reacting or playing the gold market. So let's talk a little bit about that. As a reminder, there is a substantial risk of loss in trading futures and options. Trading is not suitable for everybody, and I say this a lot, it's probably not suitable for most people. Okay, so this is a monthly chart, so it dates all the way back to the early 2000s. We can see that gold in 2002, 2004 was trading in the 300 to 450 area, eventually making its way up to 1900 or a little above. I remember 2011, and I remember this rally. There were a lot of things going on. The stock market was melting down. The US dollar was collapsing. People were panicking. It was a scary time. The US Treasury, the US debt rating was dropped by some of the debt rating agencies. And so there was a lot of panic in the streets, and the gold market reflected that. This time around, we're seeing gold move dramatically higher despite really very little panic going in at all, where you see the US dollar at historically high prices. The stock market is not that far away from all-time highs. And there, while there's obviously some negative things going on in our economy and in our society, I'm not going to say that. There's some of the other markets aren't reflecting the same sentiment that gold is. So it's an interesting time. But nevertheless, gold is the kind of market that always overshoots equilibrium. And when the trend is higher, it's hard to get that trend going the other way. As we can see in 2011, being overbought didn't really mean anything. In fact, somebody that would have sold futures in July of 2011 would have probably been within a couple of weeks or maybe a month of the high and might have had to endure a $300 plus drawdown. So it might have gotten a little ugly. Even if their overall big picture was right, it can get ugly before it gets better. So according to our monthly chart, we see that gold's going to run up against some resistance around the 1800 area, and then again around 1923, 1925. That's the all-time high. Wouldn't be shocked to see it poke a little above that, but the reality is that's probably where we're going. However, knowing gold, I also know that if something does come to fruition that turns the trend around, it's going to drop like a rock. That's how gold works. It goes up higher than it should, and then it falls faster than it should. We like to look at the COT report, which tells us which group of traders is long, which group of traders is short, and we've noticed that large speculators are net long gold, but they're not as long as they were earlier this year. And so that tells us there's probably still some buying power left to push prices higher. We're seeing the same thing when we look at the managed money group of traders. So there's still some buying power left in gold, even though we're starting to press up against all-time highs. We also see some near-term weakness in the US dollar that will at least support gold. It may not necessarily help gold move higher because let's face it, gold's been moving higher despite what's going on in the currency markets. But if the dollar trades a little lower as we expect, that should put some upwards pressure on gold. Now, the problem with trading gold futures is it's extremely risky. The margin's high, the dollar profit and loss moves pretty quickly, especially on a 100-ounce contract. There is a micro contract, which is a lot more comfortable, and I tend to push people towards that. But one thing that people overlook is the option market. You can put together, especially in today's environment, because the volatility is high and the options are expensive, you can put together option spreads that are quite attractive. For instance, you can do a call butterfly, buy the 1825 call for October, sell two 1875 calls, and then buy the October 1925 call. What results with this combination is a range trade that makes something between 1825 and 1925 with the max profit coming in around 1875. And that would be roughly $5,000 minus what you pay to get in. Getting into this trade is probably going to cost you about $600. So before considering transaction cost, you're potentially risking roughly $600, maybe a little more, to maybe make as much as $4,400 if the price of gold is right at the center strike price at expiration. That's a big if, but $600 risk in gold and to be at the money is a really, really attractive strategy. If you look at everything else, buying an at the money option is going to cost you thousands of dollars. Going long of futures is a really tough game. Even if you place a stop, your risk is probably going to be pretty large, or your odds of success might not be that great. So obviously, it's hard to teach something like that in a 3 or 4 minute video, but if you're interested in learning more, I have a new book coming out. It's called Trading Commodity Options with Creativity. It'll be out later this month, and we're really excited about it. It'll be available at any major book outlet. We are DeCarly Trading. You can find us at decarlytrading.com. And of course, if you're looking for market analysis and strategy techniques, we also have higher probability commodity trading, which is already on bookshelves. So check that out. And again, we're DeCarly Trading. Let us know if we can do anything for you.